Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, and thank you very much for listening to the show. We're on daily, we're on LinkedIn, and we're on YouTube, and we're on Facebook. We do kind of a daily show, although in today's show, talking about exactly that. Why are rates what they are? And they are not great compared to what they were 2 months ago. But compared to what they were 2 years ago, they're fantastic. Okay, so 2 years ago, we were dealing with 4.5%. Today, we're dealing at 3.25%, right? The 30-year fixed rate is at 3.27. These are averages, by the way. They're not exact, but they're very, very close to what they are in the marketplace when you go out and price your loan with your local lender, your local big box bank, or your mortgage broker. However you do get your mortgage or your rate. The rate is what you're going to pay on a monthly basis, divided by 12. So if you have a 3% rate, that is a 3% on whatever your note rate, whatever your note is rather. So it's 100,000, 3%, it's 3,000 a year, plus your interest and principal. So all of these things on a grand scheme are important to everybody because it's, how you're going to buy it. Problem is, in our particular market is you've got rising prices in both mortgages and in real estate. Now, so is that good for you? Is it not good for you? Obviously, it's not good for you because you're borrowing less because the prices of the mortgage are going up and the price of the house is going up, so you can buy less, even less. So if you're somebody making, $100,000 a year, you're going to have somebody else making $100,000 a year in the same house, paying on the same mortgage to get a decent house in Rancho, for instance. Rancho is like $500,000-600,000 as a median average. And that's a lot. Now, that for people who are listening in Albuquerque and in Las Vegas and up in Tahoe, that area, Rancho Cucamonga, is very high end. But it wasn't always like that. And some of the places, San Bernardino, Riverside, and by the way, 20% has gone up. The cost of homes in that area over the last couple of years, 20%. Think about that for a second. This is an area very, very hard hit in 2008, where you had a lot of houses underwater, and it took them a good 8-9 years before they were able to say, hey, we have more equity in our house than we owe on our property. But, looking in the rearview mirror 5-6 years ago, maybe, but today, everybody's looking sweet. If you had hung in there and kept your mortgage, yeah, you probably got a lot of equity in your property. So again, we are on a number of different podcasts. We're on the radio. We're on LinkedIn and Facebook on our daily show that we try to put together information for you. Oh, but this market, this is one of those markets whereby mortgage bankers, brokers, big banks all dread. And the reason is because the days of easy money look to be coming to an end. Now, again, 3.27 for a 30-year fixed is still pretty smoking rate. But if you were, used to 2.75, well, that's a half point change in less than 10 days. That's pretty amazing. A half point jump in less than 10 days. So there's risk in the marketplace. Why are people afraid? What do they think is going to happen? We had a change in administrations, right? And we've had COVID vaccines that they're handing out to the tune of about 1.5 million of these a day. So the steady, slow progression towards reopening of the economy is really what this rate rise is about. However, and I've asked a question, I'm going to ask it here, and I'll ask it in a sort of a way that says you don't have to answer, because quite frankly, I can't hear what you're going to say. So it says that, what is the question? I wrote it down. Borrowing costs brings in more buyers on the lower economic scale. So price versus access. How does the industry deal with the fact that every time price goes up in the cost of a loan, lower end people on the lower end of the economic scale get priced out of the market? What do we say? Every quarter point, the rate goes up. Another million people can't refi or purchase because they're priced out of the market. Now, we've had over the last almost a year, right? March, isn't it, Daryl? March 15th is the COVID anniversary?
Yeah, it was March, middle of March.
Right, middle of March. So in the middle of March, when the markets crashed, we saw mortgage rates really dive. And it was because the Fed stepped up and said, okay, we're going to buy the mortgage-backed securities and we're going to buy the treasuries. We're going to stabilize the market. We're going to say, okay, we're going to step in. 120 billion a month, 80 billion of treasuries and 40 billion of mortgage-backed securities. Well, that stabilized rates and really drove the rates down to in the mid twos. But this also allowed people at the low end, people who don't make 100,000 a year, people that make $30,000 to $50,000 a year in a two-income household could finally afford something that they could buy because the rates were so low. That's when we saw the demand on housing go up and the prices go up. Now we're seeing the rates go up just as the economy is starting to recover, which means that those people who lost their job to COVID, who would have liked to get into this market, can't now get into this market because the price is going up. Is this a manipulation? Is this something that we say, okay, prices are going up because risk is there, or are prices going up because people want to make more money? Now, in my business, in the mortgage business, I own a company called Malibu Funding, right? It's a company I work for. That particular company, and as Warren Buffett says, when it's raining gold, put out a bucket. Well, it was raining gold last year for mortgage bankers, brokers, and big box banks who are doing mortgages. They were just, and I've seen it twice in the last 15 years, right? In 2005 and 6, it was raining gold. Well, this COVID season really, you could make a ton of dough, and most mortgage companies did. That's why you see a lot of companies either merging or going public. Why? Because the people who want to cash out in that business, in my business, do it when the market's the hottest. This year, we've seen 5 different private lenders go public, whether it's LendSure, whether it's Quicken, now Rocket, or whether it's United Wholesale Mortgage, whether it's Home Point, whether it's, there's other companies. So is this really good for the low end of the spectrum to get into the housing market? Because long term, the biggest and healthiest way to continue the American success story is to make sure everybody's in it, right? Don't exclude people because you want to make money, I guess is the kind of what I'm saying, right? So I guess what would really be a good thing is if we could have a pool of money that we could continue to lend at low interest rates to people who can't afford the higher rates or higher prices. Let them get in on it. It's the only way we're going to make sure that everybody is rowing in the same direction economically. And that's the biggest thing in the recovery anyway, making sure that everybody is coming along, not just guys who own mortgage companies or people who are taking advantage of low rates, buying real estate and watching the price raise by 10% last year. Anyway, all these are very interesting topics. I love them all. Enjoy talking to you about it. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show and listening each and every week. We're on several radio stations, as we said earlier in the show, as well as the Big 8 podcast. Daryl, you got a list of those podcasts for us?
I sure do, Jeff. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and coming to Podclips.io.
Okay, that Podclips.io coming soon. There's a lot of great different types of podcasts in our industry, in the business world. There are several. I've listened to them. very instructional and entertaining. So when that gets going, we'll continue to let you know. We bring to the show a lot of people from different walks in our profession. Today is no exception. Maria Schroeder has been on the show before, and she joins us from Quantic Bank, a new player in the mortgage business. Maria, how are you?
I'm doing good, Jeff. Thank you for having me on your show.
Okay, and thank you for coming on to the show. So tell us something about the bank, what you're doing, how you're helping, and we got rising rates out there. So obviously the competition for individual mortgages is becoming fierce. All of these things, give us some opinions about what's happening and something about what you guys are doing.
For sure, the rates are rising. So I think that the refi boom is slowly coming to a slowdown, and possibly it's going to be more focused on purchases. And Quantic Bank actually is a portfolio lender. We're a federally chartered, FDIC insured bank.
Okay.
We have our designation from the federal government that allows us to be exempt from ATR and some of the Dodd-Frank regulations.
Uh-huh.
And with this designation, we were able to develop programs that can help people who have kind of missed the boat with the regulations, like the self-employed borrower with volatile income or non-recurring expenses, people who are working multiple jobs, people who earn income, commission income, such as like servers, bartenders, people in the show business and industry. Now we have programs that you don't need to have declare income, no debt ratios involved. People who are retired, but they have tons of reserves and assets, and they can't really go get loans. They have to kind of go to the private money world before Quantic Bank was able to come out with these programs. So, and I think it's just an amazing opportunity for realtors, mortgage professionals out there to. Now we've opened up an area that hasn't been served for at least a decade with the changes that happened after 2008.
Let me ask you a question, because I think there are a lot of people who are commissioned. Right here in California, for instance, we had an election, and part of what was voted on was whether Uber drivers were going to be 1099 or not. Well, it was voted in that yes, they are going to continue to be 1099 employees. So they're looking at ways by which they can use that income more easily in order to get a loan, in order to get in on, even now, even if rates go up. I mean, we say they go up, what are they, 3.25% on a 30-year fix? It's still pretty low on a purchase. Are they able to use their particular income with Quantic in a much easier way than they may in order to get a loan from, let's say, Bank of America, because they don't have the advantages Quantic does?
Sure. Correct. Because we are an alternative lender, we're kind of in between conventional, and we're not even exactly non-QM, right?
Right.
So we know that these types of borrowers are out there that have, like, the Uber drivers or the DoorDash people that might be doing both, and
right.
With our programs, because we are doing kind of like a little narrow niche. If they have a credit score of 680 above and they have 25% down, we're not going to ask them about their income, because we're looking at that as, hey, that borrower has demonstrated that he can pay his bills and he has assets that he can put down on a home and get into a home, and now he has some buying power, and he's not restricted because of these jobs that are out there to serve their lifestyle, basically.
That 25% down, how does that have to be? Does that have to be seasoned? Can it be a gift? Can you have multiple lenders on a particular piece of property with that 25% down? How do you figure it?
We do have to source the money, and we only need 30-day seasoning. But
Okay.
with our guidelines, we will allow 100% gift funds for the down payment, for the reserve requirements. We have reserve requirements on our programs, and depending on the loan amount, it can be as low as 6 months, as high as 12 months.
Okay.
And we are very lenient in the way we source it. We just need the current 30 days and or a gift letter and proof that the donor either gave them the money or wired the money right into escrow for their, the transaction to close.
Now, the reason you do this is because not only do you're your own bank and you have a different charter, is it because you service all your own loans and keep them, or do you sell them off in the private sector? I'm just curious about that.
This is where it's Quantic Bank is a secure lender or option for a lender is because we are a federally chartered bank and we
see.
Portfolio this. Ultimately, we are going to pool them and securitize them, so then we can do more and more of this because there is a huge market for this that's been ignored for the last 10 plus years. But this is definitely, we're not dependent on a hedge fund. We're not sending it to an investor. And, these are programs that are being done by our board of directors, and they totally have control over them.
Where is Quantic?
I know because I worked for non-QM lenders, and, I think that I was, the last time I was a guest on your show, we talked about them.
Yep.
The risk with non-QM lenders right now, they have to, when they do these alternative products, they have to get their blessings from their warehouse lenders, and then they have end investors, and they can be multiple ones. So sometimes on the 11th hour, things can change. And with Quantic, because we are one-stop decision makers, that doesn't happen.
Where do you see Quantic going from here? You obviously are opening up new. And by the way, where are you located? The bank itself.
Quantic Bank is the headquarters is in New York City, in Manhattan, on Rockefeller Plaza.
Hey, Maria, I've come up to the end of the show. I apologize. That went by really quickly. But could you shout out a phone number in case somebody wants to contact you directly about one of these fine products?
I totally. 949-878-7045. I'm so sorry. I'm so long-winded. I get so excited.
No, it was great. Don't even. No, that was good. It was very good, very informative. But we just ran out of time. But thanks for coming on the show again. We'll have you back soon enough to talk some more about what you're doing at Quantic when the rates rise. And thanks very much.
Oh, thank you, Jeff, so much.
Thank you very much. Okay, that's Maria Schroeder from Quantic Bank. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. You can hear this show every weekend. We're on several stations in several different states, and we do appreciate those people who call and ask questions about, the programs or the guests. You can also see this particular show on YouTube. If you go to Jeff Barton, the Mortgage Voice, you will see me and the guests and their telephone numbers, and you can contact them directly. We're on 8 different podcasts, plus a couple of new ones coming up. Daryl, you got those names for me, please?
I do. It's Apple Podcast, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and Podclips.io. That's the coming soon one.
Excellent. Yes, I've been to Podclips.io, and I liked all of the business stuff they had there. It was very informative. We fit right into a great format, a great number of different shows, which have obvious benefit for people who listen on a regular basis. I know our show is topical because, we talk about rates, we talk about programs, and once you get your mortgage, you probably sail on down the road. But tell your friends, come to the stations, come to YouTube, say that you like it. It helps us get the message to other people. And quite frankly, there's not a lot of general talk shows. Most of it's about commercialism. Regardless, today with me once again is Charles Giscombe. He's from Malibu Funding out in Nevada, and I want to have him on. Charles, first off, how are you?
I'm doing great, Jeff. Thank you for having me. Always a pleasure.
Thank you very much. Rising interest rates, what's happening in the marketplace, and where do you think this particular, I guess, rise ends before we get a little bit of a respite?
Like we always say, Jeff, I'm not the mortgage Nostradamus, but I will say that I do believe that, it's going to happen. The interest rates are going to rise. It's just a matter how fast we get to the end number. Still low enough for people to jump into the market and still transact. So I wouldn't be so worried that way. I just truly feel like if you were on the line, teetering on the line of the refinance or looking for a purchase, thinking the low interest rate was going to come, now's the time to do it. I do foresee it trending up for a little bit, but I do believe it'll come back down. But I still feel like the rates are low enough. I just got a couple of clients, 2.875s, and they were ecstatic. And that was with the price worsening. So still a good time to jump in. And I truly feel, don't be afraid. And if you're looking at locking that rate in right now and you're hesitant because you're worried about the next, what's coming, lock in now because they will go up because that's just the trend.
Hey, Chuck, explain what lock-in is. I think, we throw terms around because we've been in the business forever. But some people who listen to the show don't understand. They go, okay, I got to fill out something, and then what happens after that? Explain a little bit about what lock-in is.
Okay, for sure. Thanks. That's a great question, Jeff. So when a client comes in and we initially start the process, we run a scenario based upon what their transactions will look like. Obviously, it involves what their credit is. Involved what the purchase price is and the value of the property is, and the different financial documentation that they'll bring to the table. Once we get all that laid out, we go into our systems and we look. If a client is interest rate conscious, we'll go in to find out what the best interest rate is available to a client for whatever particular bank or lender we decide to go with or utilize to get the transaction done. Once we start that process and we start the submission process, and even before that, when we're looking at these loans, the banks buy money at a certain interest rate for certain amounts. They might buy a certain amount of 3.875. They might buy a certain bulk of money at 3.375. They might buy a bulk at 2.875. Based upon what our borrowers' financial structure and credit structure look like, they may be able to partake in interest rates that may be lower. If they're more risky, they may have to go into a higher interest rate bracket. When we say lock, we mean when a person understands that they have made their submission and they're looking for a particular interest rate, you can get these interest rates sometimes at no cost. If the interest rates are low, you can get a low interest rate at no cost at all to you, and you can lock that rate and have that rate locked for 15 days, 30 days, 45 days, and 60 days. When you lock the rate, you're guaranteed to have that particular interest rate that was quoted to you by your loan officer and your broker that was given by the lender, okay? Once you lock in, you can guarantee that your rate won't go higher than that. When you say, I want that interest rate for my transaction, and you decide on it and you agree upon it, we can lock that rate for a certain period of time. Most times we lock the rate for 30 days for a client so that they don't have to worry. So they say, hey, listen, interest rates are going up. We make the submission. This is the perfect time because the prices are worsening. So a client comes in and says, Charles, I want a 2.875. I'm worried about the market going up. I'll say, fine. We can go into the system, lock that rate for you so that for the next 30 days, a 2.875 is guaranteed to you on your next transaction because we locked it for you for a certain period of time. When that period of time is over, you can extend that lock, and it may cost you some money to do so, but at least you know you have the rate that you asked for and that was quoted for you by your loan officer and your lender.
Okay, excellent answer to a question that I think many of the people who listen to the show, because we throw around terms like loan lock and what the lock is, to understand and have it explained. Explain to me why, or what rather, is a program today that you would recommend not locking right now? Is this something more of a non-QM or non conventional type product where the rates really don't change that much because they're higher rates anyway?
Absolutely. So depending on what I find, once again, we're very heavy at Malibu, and me and Jeff talk about this often. Depending on what your client's financial structure is, what your borrow structure is, sometimes they don't want to provide the traditional documentation.
Right.
And so that would take them out of the traditional loan realm. When I say traditional loan, I mean a FHA, Govy loan, USDA, VA, or the Fannie Mae, Freddie Mac conventional loan program that is in. That's a traditional or conventional loan. What Jeff is talking about is if your structure doesn't require you or doesn't allow you to provide that documentation and you want the path of least resistance, you can go to what we call a non-QM loan. A non-QM loan may offer you a higher interest rate, but it may offer you much less red tape and easier guidelines for a borrower to follow in order for them to get qualified. Now, what Jeff is talking about as far as the interest rates are concerned is those interest rates may go up too, but they're not going to be like the traditional interest rates. So you don't have to worry about locking those particular loans. You can float those loans because those interest rates are going to probably be around the same. They may move a little bit, but not much like the regular traditional mortgage loans may move, and the interest rates that are backed by mortgage-backed securities. So what that means is you have the ability to look around. As long as the structure meets you, we can find a program in a non-QM from a non-QM platform that's comparable to each other, and that way you can not have to lock that one so much and just find what's the best one that meets your need and meets your structure best.
Okay, rising interest rate environment, home prices going up. Where do we see this summer if COVID really recovers the way we all think it will when people get their shots? I think it's almost something that you're going to see rising home prices, rising interest rates, and more people back in the marketplace competing for fewer and fewer homes. That doesn't sound like a good thing. What's your opinion on that?
I mean, it's a cycle. It occurs all the time. You know, those who are first will be last. Those who last will be first. Unfortunately, now in the country, everybody's pretty much on the same thing. There's only certain states that hold their value and never really have to go through what everyone else has to go through. Like in Las Vegas, for sure. When it's bad, and when it's good, it's great, right? In Nevada. And so at the end of the day, I do see that the interest rates will go up. There will be a lot of houses available initially because when the pandemic's over and now individuals unfortunately, houses will be foreclosed on. There might be inventory at the bank that they have to get rid of.
Maybe.
But eventually, it will be purchased up right away. And now you'll be having people compete for the same home over and over again. Maybe a bidder's war might even start. You know what? In these situations, even though it seems like it may be a bad thing, it's still competitive. And if you can get in, you still need to get in. Because at the end of the day, eventually a cycle will turn. And that property that you had to bid for, fight for, eventually there'll be some upside on it. It's one of the only things you can get into that we know eventually will come back around and you'll get your value. You know, even if you feel like you're losing now, you'll win later. It just depends on if you're able to play the long game. That's what it's about. And I do believe that even with higher interest rates, the interest rates were high a long time ago, and there still were many people buying homes. I don't feel you should fear it. You should obviously get with a loan officer and a company that will walk you step by step, help you understand exactly what this process is, and help you make the best decision for you and your family, whether it be a personal need or investing needs, commercial needs. That's what it is. There's no reason to be scared of the market. You just have to approach it a little differently when the interest rate high and the supply and demand flips around.
Chuck, could you shout out your phone number for somebody who wants a terrific loan officer in many places, but certainly in Las Vegas, Nevada?
Absolutely. Be glad to, Jeff. My number is 702-328-5191. Again, 702-328-5191. And my email is charles@malibufunding.biz. That's Charles at MalibuFunding.boy Isaac Zebra.
Charles, thank you very much once again for coming on the show. Great information today, by the way. I really appreciate it.
Jeff, thank you for having me. Always a pleasure. Appreciate it.
Thank you. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in each and every week. We're on YouTube. We're on 8 different podcasts. Daryl, you got a list of those podcasts for me?
I do, Jeff. It's Apple Podcasts, Google Music Play, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, and soon to be Podclips.io.
Okay, excellent. That Podclips.io, when it comes available, we will let you know. YouTube, if you go to Jeff Barton, the Mortgage Voice, you can see me. Hey, yeah, imagine that. You can see me and the guests on the shows each and every week. We do bring interesting people who have been in the business, who have a lot of experience in many aspects of what goes on in real estate and mortgages. With us today is a loan officer for Malibu Funding, who works also as an entrepreneur in his own right, is Josh Thompson. Josh, how are you?
I'm great, Jeff. How are you?
I'm fine. Thank you very much. And thanks for coming on the show. Okay, first off, right off the bat, your project in Inglewood, California, how's that going?
Oh, good. We demoed the existing structures that were on the site, so we've done that. Permits almost there. The process kind of got slowed down due to the pandemic.
Yep.
The city kind of got a little slower, and they were kind of already not the fastest. So, but close on the permits, and so we'll be building in no time. But it's going pretty good.
Now, when you choose a project, and this is for people out there who are looking to either develop themselves, do an infill, or maybe build a 4-unit building and live in one, do you choose the city or do you choose the location? And what I mean by that, the city, i.e. the ease by which you can build, or the location because it's just the best place to build and you don't care about how difficult it is to build?
You kind of want to take into consideration all of those factors. I mean, me personally, I kind of look at, I base it on an economic standpoint because it still is an investment at the end of the day. So you definitely want to make sure that you can, find something in an area that may be up and coming, or where you can, for example of the Inglewood, that project we bought in 2015 before this whole stadium thing was really announced, but news was kind of brewing. And, so we're able to pick it up for a cheaper price, and there's a appreciation value there. So definitely take that into consideration, but also you want to look at, the local municipalities and how the permitting review process is, and you kind of want to assemble a team that maybe, especially your architect or designer or engineer, you have someone on your team that has some sort of relationships with these plan checkers in the city to kind of help expedite your process a little bit too. So consider all things. Yeah.
I agree with that 100%. I usually see people who are successful are people who have obviously been around a long time, but they know the plan checkers, they know the people who are coming out to inspect the property, they know enough people within the system to make it a bit smoother. It's difficult to process enough, and in certain areas, it's very expensive. How have you found your project? Is it under budget, on budget, over budget?
Oh, definitely over. It's definitely over. And time is one of the things that,
right.
That's the thing that really makes things go over, because it's the more time that goes on, especially if you're, regardless if you're using borrowed money, the time is more, interest that you're paying on money. And then even if you're using your own funds, you're tying up your own money for longer than you anticipated. You're in turn losing money there too. So, yeah, the time is the most, and other things too. I mean, some of the, there's new changes that we have to make, that planning has made us make, that in turn will make the project cost more money. So there's a lot of changes that have made us go over budget. But that's why you want to find an area that is appreciating in value, because I think the time we've lost on this project, the more things in Inglewood that are being developed that are adding to what the market value of the property will be when it's completed. So that's one thing that we have on our side.
Right. For those of you who are listening from not in the Los Angeles area, Inglewood is the city where they just built the new stadium, SoFi Stadium, which is an architectural wonder in and of itself. It's by the old Lakers Forum, which is getting renovated by Steve Ballmer, who is owner of the Los Angeles Clippers. So both of these projects that have occurred while Josh has been building it is a good thing, right? It's going to push the price for you.
Oh yeah, a great thing. And there's so many. I mean, the whole landscape of that city is changing, and
Right.
the property values just on speculation of this have already increased dramatically in that area. But yeah, I mean, they're bringing so many new retailers into the city.
Right.
And SoFi Stadium is just one component of that development. There's so many different things that are being built on that property. It's they're building a 300 unit, I think,
Right.
condominium place. There's a hotel that's there that's high end. I mean, they even have a man-made lake in there for Christ's sake. So it's there's a ton of stuff going on, and something I would compare it to. I would kind of compare it to what Staples Center did for downtown Los Angeles. Staples Center and LA Live, right? There was Staples Center came in downtown. Prior to that, downtown was a pretty undesirable place in Los Angeles to live, and property values certainly were not, at the highest at that time. And once that stuff came in, there's been exponential growth in downtown Los Angeles, and I see the same thing happening with Inglewood. And I think it's going to be even bigger in Inglewood because of that SoFi development. It's about 12 times the size of what's going on at LA Live. So.
Excellent. Okay, so let's switch gears somewhat into your loan officer hat. We see rising rate environment, and that is either going to kill business or make everybody try to kill each other to get what's left of anything that's cheap on the marketplace. Where do you see it going, and how are you, advising your own clients?
Lock rates.
Right. That's true.
It's
right.
Not, lock. Definitely. I mean, even this past week, we've seen a little slide. As it's, I think and this is me personally, I think rates still are not going to, these rates are historically crazy. I mean, they're so low that it's,
Yep.
Even with a raise in rates, they're still going to be lower than they've been at any point in history other than, right now or a few months ago. But,
Right.
I think that maybe, once rates do go up, a bit, maybe we may see some of the prices come down out there in the market. I know the market where I am, LA, stuff is just astronomically high right now. So maybe the rise of rates may be a good thing. But if you're a homeowner and you have a rate that's anything over 3.5%, I would say really look into refinancing ASAP, just because you don't want to miss the boat on this thing. So,
well, every time there's a quarter point raise, we have a million less people that can get into the marketplace. So it's important and incumbent upon people, it's unbelievable. If you want to refi and you haven't done it yet, where you been? That's my attitude. It's like, come on, it can't go any lower. I mean, we were seeing rates a point lower than they are now for a 30-year fixed, and now they're edging up to closer to 3 3.33%, 3.5%. We may see that by 1st of March.
Yeah. So but that in turn, I would think prices will have to come down a bit. Once those changes start taking effect. So. It could be good for that sense. And these rates can't stay this way forever.
Mm-hmm.
So,
Well, Josh, thanks very much for coming on the show. Could you shout out your phone number, a way by which people can get a hold of you, either as a loan officer or as somebody who is in development who needs some expertise in that area?
Oh, yeah. My number is 323-945-5694. And thank you for having me, Jeff. It was great.
Josh, thank you very much. It's Josh Thompson from Malibu Funding, and I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, and thank you very much for listening to the show. We're on daily. We're on LinkedIn, and we're on YouTube, and we're on Facebook. We do kind of a daily show, although last couple of weeks has been rough. It's been rough because the mortgage has changed. It's one of really sitting back and trying to manage the amount of business you're having come in the door, and rates would go up and down a little bit to try to slow or pump the brakes, because there's only so many deals you can do if you have an infrastructure that is, only so big, right? I'm not United Wholesale, and the guy over there, Matt Ishbia, said recently in an interview, I don't know if it was Housing Wire or whether it was Bloomberg, he said, and he's the guy, by the way, that just went public with his company. I think the shares were, I don't know, $10.50. Anyway, he became a billionaire overnight, this guy, because he went public. He said that hiring 1,000 people was a gamble for him at the beginning of the pandemic. What he saw was rates going to plummet because the Fed was kicking in, mortgage-backed security money, and they were kicking in treasury money. So he hired 1,000 people, and most of them underwriters. So he was able to keep up with the volume regardless. And they're smoking as a company. I don't know what's going to happen if rates go up more, which I assume they would. I was predicting 3.5%. We may get there next week. But most companies, no, they don't have the capacity to be able to hire and fire at will, take on a lot of new people on a gamble. No, you just don't have that. So if the brakes were pumped a little bit by rates rising and lowering, well, that's the reason why, because you can only have so many loans come through the door. But what is happening now with rates the way they are, 3.27 for the 30-year, 2.75 for the 15, 2.88 for FHA. FHA, by the way, 2.88. We're going to see 3.25 during the next month to 6 weeks if we keep going the way we're going. And the reason we're going the way we're going, the 10-year Treasury is at 1.5. And the Treasury yields are like that because they're trying to attract borrowers. You have to lower the price of the bond and up the yield in order to get people interested in buying Treasury debt. And the real reason that is because the safe haven is you don't need it anymore. Why? Because the economy is recovering and people are investing their money elsewhere. So Treasuries, in order to attract people to buy the debt, have to up the yield and lower the price. Simple, straightforward supply and demand economics. When the economy is bad or people are afraid, they're going to buy Treasuries. Why? Because it's the safest bet in the world. But as Treasuries go, so does interest rates. Now, we talked about this many times on the show. We talked about why interest rates are what they are. We talked about why Treasuries are what they are. In an earlier segment in this show, we talked about, maybe there's a bit of a market manipulation. Maybe what we really need is a two-tier system, i.e., a system whereby lower income people can get in, get bought, buy housing, and get in on the generational wealth that's created when you buy real estate low and you watch it grow. As you pay down the debt, you increase your equity, and as you increase your equity, the price usually goes up. At least it's been that way for the last 25, 30 years, 40 years that I've been in the business. A house that I bought in 1990 for $500,000, 1991, is now worth $5 million. Okay, now granted, I live in an area that is a high demand, but if you're within 100 miles of the ocean, and in the world, you're dealing with about 75% of the world's population lives within 100 miles of the ocean. All the real estate price goes up, and it goes up from the outside to the beach. right? So in wherever you are in the world, you're going to see that prices, when they start to go the other direction, i.e. if there's a recession or if there's a bubble like there was in '08, or if, anything else happens, some catastrophe, some weather incidents, earthquake, you see prices fall in the interior first and they flow to the beach. So the last places to be hit are people who live in the most desirous areas. That's how it works. And are we at any of those stages right now? No, we're not. And have we come through something that has been so catastrophic that it has affected real estate prices uniformly everywhere? Yes, it has. But it's affected it in the direction that you don't want it to go if you're looking for a bargain. Prices have gone up. Last year, 10% nationally. I mean, at the beginning of last year, I'm talking what is happening in the real estate market. We're going to see prices fall. We're going to see inventories rise. We're going to see more rates go up. Well, none of that happened because COVID happened. And we had this. Daryl, can I ask you a question? Maybe you know.
Sure, of course.
What's a K-shaped recovery?
I have not heard of that.
Okay, so
You know
you've
what
heard.
a rail is, but it doesn't. Those didn't look like a K.
Right, and you know what Kmart is, right? Of course.
Exactly. I'd say it's probably the peak and then the valley and then the peak again.
Yeah, I think that's right. I mean, this V shape, right, down and up, which is what everybody wanted to see. Had that happened, we'd have a different president as we have today, but it didn't happen. And again, I don't know how much of this is manipulated, but I do know a couple things. When bankers and mortgage bankers and people at big box banks see the opportunity to make money, they go for it. Economy's improving, rates are going up. There is a direct correlation to that. Now, we are a jump and ahead away from actually seeing more jobs created. We have 10 million people still out of work from when COVID happened. We originally had, I think it was 25 million people out of work. Now, a lot of those people have come back to work. We're seeing COVID cases go down. We're seeing the vaccine go up. And these are all great things. But it's troublesome in that I think a lot of people want to see rates rise in our industry because
So the definition, Jeff, is the K-shaped recovery occurs when, following a recession, different parts of the economy recover at different rates, times, and magnitudes. There's a contrast to even a uniform recovery across the sectors, which would be V-shaped.
Right, exactly. Okay, very good. And I think
they're different for different industries.
That's excellent, right? So if you're in the restaurant business, you don't see any recovery, right? You're not going to see a recovery until everybody comes back to your restaurant, if it ever happens. May never happen because people get scared. They don't want to be around people anymore. Now, younger people, obviously, if it's a 10-year cycle whereby you see a recovery at that point, well, it's a different thing because guys my age, we're not going to be around at restaurants anyway. We're going to be in, trying to just slop the soup up at the local whatever it is where I'm living, local nursing home.
Eating cycle 4 dog food, yeah.
Yeah, exactly. Oh man, those poor people. And by the way, did you see what's going on down in Texas? And those poor people down there, they got sold a bill of goods and now they have to pay for it. It's awful.
I've heard in the news today that a musician down there literally froze to death in Texas.
Awful. Just awful, awful, awful. All because there's that political divide and how people, treat each other and the way they're sold a bill of goods. Had Texas been plugged into the network nationally, this wouldn't have happened. Enough about Texas, enough about my political views on whether, the little person suffers when people make political footballs out of energy and food and gasoline, simple things that everybody needs. I don't care whether you're the richest person on the block or the poorest person on the block, you need those three things. And if you don't have them, you got to look to somebody and say, well, why don't we have them? And hopefully that won't happen again. But, you know how it is, right, Daryl? I mean, it
is how it is.
It is how it is. And anyway, and I'm Jeff Barton. I'm glad to listen to the show today. Thanks very much. And, we'll see what rates do next week. Hopefully they'll go down a little bit so more people can get into the market. We'll see you next time, and thanks for listening. I'm Jeff Barton, and this has been The Mortgage Voice.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.